Charles Schwab Growth ETF is a top choice for investors which is focused on US large cap growth stocks. So what makes this growth ETF special? Charles Schwab Growth ETF just announced a 4:1 stock split, making it even more appealing to investors. In this video, we will explore what this split means for your portfolio, this ETF's performance over the last decade, and why it is positioned for future growth. So if you are interested in a growth ETF which is more affordable and accessible, stick to the video until the end. So let's get started. But before we start, hit that like button and subscribe to the channel if you are new. As always, everything shared in this video is for informational purposes only. So first thing first, what is Charles Schwab Growth ETF with ticker symbol SCHG? SCHG is a part of Schwab's ETF lineup and it is focusing on US large cap growth companies. It tracks the Dow Jones US Large Cap Growth Index, which means you get exposure to some of the most successful companies in the market, like Apple, Microsoft, Nvidia, Amazon, and others. In total, SCHG holds 231 stocks and has a super low expense ratio of just 0.04%. That is one of the lowest you will find in any growth-focused ETF. This low expense ratio means for a $10,000 investment, you are paying only $4 as a fee. Low cost means more of your money stay invested, allowing you to take full advantage of market growth without high fees eating into your returns. That's why SCHG is such an attractive option for long-term investors. Let's check the historical performance of this ETF over the last 10 years. Over the last decade, SCHG has delivered a strong average annual return of almost 16.5%, and much of this growth has come from the dominance of the tech sector, which has been a powerhouse in the market. Companies like Apple, Nvidia, and Tesla have contributed significantly to the SCHG success. So if you had invested $10,000 in SCHG 10 years ago, that investment would now be worth almost $45,000. That's a massive return for a passive investment in a low-cost ETF. Even during market corrections, SCHG has shown resilience, recovering quickly mainly due to the strength of its large-cap growth stocks. How this ETF is doing against its competitors. For SCHG, two of the biggest rivals are Vanguard Growth ETF with ticker symbol VUG and iShares Russell 1000 Growth ETF with ticker symbol IWF. Let's break down the key points of comparison. When we look at the expense ratio, SCHG wins here with its 0.0% fee. VUG is right there with the same low fee, but IWF lags behind with a higher expense ratio of 0.19%. In terms of holdings, SCHG 231 stocks focuses on a more concentrated approach, which can be an advantage if you are targeting growth, while VUG holds 191 stocks and IWF holds 398 stocks. In terms of performance, over the last 10 years, SCHG has returns almost 16.5%, slightly edging out VUG 15.5% annual return, and IWF's 16.3%. It may not seem like much, but over the long run, that extra boost can lead to substantial growth. In terms of affordability, SCHG is more affordable compared to its competitors VUG and IWF. SCHG is trading at $104, whereas VUG is trading at $383 and IWF is trading at $374, much higher than SCHG. Therefore, it makes it affordable for small investors to invest. All three ETFs are strong options for a growth-focused investor, but SCHG combination of lower fees and slightly better performance makes it a top pick for cost-conscious investors looking for solid long-term growth. So what is the big news about 4:1 stock split for SCHG? Let's dive into this big news. SCHG 4:1 stock split, which will be effective on October 11, 2024. So what does that mean for you as an investor? Imagine SCHG was trading at $400 per share before the split. So now after the split, you have 4 shares, each priced at $100. But the total value of your investment remains the same. Stock splits don't change the overall value of your holdings, but they do make shares more affordable for smaller investors. Lower prices often attract new buyers, which can increase liquidity. This means there could be more trading activity, and that can help boost demand and potentially drive the share price higher. Historically, stock splits can create more opportunities for growth, and with SCHG's strong track record, the split could be a catalyst for future gains. So how does the future outlook look like for SCHG? Looking ahead, SCHG future looks bright. It has significant exposure to the tech giants like Apple and Nvidia, companies that are leading the change in areas like artificial intelligence, cloud computing, and clean energy. With this sector expected to keep growing, SCHG is well positioned to benefit from this trend. Growth-focused ETFs like SCHG tend to be more volatile than value ETFs, but for investors willing to face the ups and downs, the potential rewards are huge. The recent stock split could also bring in more retail investors, which could push prices higher over the long term. So, to wrap it up, SCHG offers a powerful combination of low cost exposure to leading US companies, and due to the stock split, it makes even more accessible to everyday investors. So, if you are looking to add some serious growth potential to your portfolio, SCHG is definitely one to watch. Just remember, growth stocks can be more volatile, so always consider your own risk tolerance. That's all for today's video. If you found this analysis helpful, make sure to like the video and subscribe to our channel if you are new. Thanks for watching, and I will see you in the next video.